Hi, and welcome everyone. We hope you are having a great day so far, and thank you for joining us for our bank insurance update. My name is Nancy, and I'll be your moderator today. Before we dive into our presentation, just a few housekeeping notes to mention. First, everyone on the line has been muted to limit disruptions. If you have any questions, you're welcome to share them with us using that questions feature in your GoToWebinar control panel. At the end of the presentation, if we have time, we'll go over those questions together, and if not, we will reach out to you after. This webinar is being recorded and you can expect it in your email along with a link to download the slide deck tomorrow. And finally, upon leaving this webinar, you'll be prompted to complete a very short survey. Please take a moment to share your feedback with us on your way out. We'd love to know what you thought of the presentation and any topics you'd like to see from us in the future. At this time, I'm going to welcome Jason Keith, our Technology Risk Consulting Manager, to introduce our speaker today. Jason?
Thanks, Nancy. I wish you'd told me. It looks like I have a halo here. I wasn't paying attention to what's behind me, but I'll drop off the screen here in a little bit once I introduce Dennis, and that way you won't have to stare at it that way. Thanks for joining us, first of all. You know, at Saltmarsh, I think our goal is to just try to talk about, we love to talk about banking, we love to talk about interesting topics, and our goal is really just to bring unique stuff to you and things that we think are interesting or things that we hear from you that you'd like to hear more about. And with that said, I'd like to bring Dennis into the conversation, and what he's going to talk about today is really what's going on in banking insurance. He's going to spend a little bit of time on cyber, which is really kind of, for a lot of you, has been a bit of an issue of late in your renewals and as you're dealing with answering questionnaires and what's going on there. But he's also going to go a little broader and just talk about what's going on in the bank insurance space in general. And to give you a bit of a background on Dennis, what he is he was partner, now he's managing partner of financial institutions for AHT Insurance, which is owned by Baldwin Risk Partners. I think now you are just BRP, maybe, Dennis, but so you are a broker of insurance and you deal specifically with banks. So you kind of have an understanding of what's going on in the banking space in general. And what I find probably valuable in talking with you too is that you deal with lots of insurance companies. You're really placing what's the best insurance for the bank, or dealing with, you know, different riders of coverage, and therefore you kind of have a broader perspective. And then I love that you're tied directly into banking specifically. And you know, you and I had talked in the past and looked at some slides. You had some very, which I didn't know it existed. There's an ABA agent symposium. There's some very specific statistics about what is going on in the banking space in general and insurance. And I found it a fascinating conversation. We thought, well, let's just try it here and see how it goes. So if you don't mind, Dennis, I'll let you take it away. I'll drop off the screen. I'll come back in at the end, if that's okay.
Sure. Thank you very much. And good afternoon, bankers. I guess for my West Coast bankers, good morning. And we're just going to talk a little bit about what I'm seeing in the D&O, more specifically the cyber liability space for the banking sector. So I'm just going to get right to it. I got a lot of slides here. I'm going to hit on a couple of points each one. You'll get a copy of the slide deck afterwards. And then obviously, as you know, feel free to ask any questions. So let's first talk about what are some of the claims trends I'm seeing. And I'm going to share some data that I got from the ABA symposium. First of all, on the D&O side, mergers and acquisition claims still exist. If you're a publicly held bank and you get acquired, it's not a matter of if, it's a matter of when. The litigation tends to be frivolous in nature. Usually, you know, a couple $100,000 of settlement. It is covered by insurance. Basically, they're holding up the transaction to ransom. They're not the most reputable law firms. You see some compensation claims, antitrust claims, but really M&A is the big one on the D&O side. Here's some data for you. You know, you see, interestingly enough, though, that we found that the depositor and lender claims are more common. It really is the regulatory and the shareholder claims, particularly for the public banks, which have the most chance of severity. You know, so the severity is more like the average and the max. We've seen some regulatory claims $10 million and above against the banks. That's really on the D&O side. On the employment practices side, location is our real estate friends say, if you are a California bank or California entity, the litigation is so transparent and frequent that retentions are sky high for California entities. Pricing has gone through the roof. We are also seeing a very interesting trend on COVID-related EPLI claims. You know, people saying that I don't have a safe provision at home, or they're not giving me an opportunity to work from home. So be on the lookout for that, and specifically third party. Your employment practices liability connects into third party, so it doesn't have to be the employee feels harassed or discriminated against. It could be the FedEx person or the Xerox lady, whoever it is, and it could be related to COVID if they feel like you didn't have the right masks and they feel they were exposed to something. They could bring a third party EPLI suit or employment practices liability suit. I gotta put a quarter in the quarter jar every time I use the acronyms. I'll try not to do that. Us in the insurance industry love to use the acronyms. And of course, Me Too is still going, and there's a lot of harassment claims still associated with that. EPLI discrimination is still the top category as far as frequency, and there's also the top category as far as losses, severity. So we still see the most discrimination claims, and they are the most severe for employment practices liability. Again, from the ABA data, that's very specific to the banking sector. Cyber, ransomware. I'll stop here. I just want to highlight what we're seeing. And I think the important thing to know is that the number of ransomware claims in all sectors, and it's impacting the cyber liability for all industries, is increased dramatically from both a frequency and a severity standpoint, and it's impacting the cyber market. And I'll give one example. We had a bank that was about a $1.2 billion bank, West Coast. This was probably in June of 2021, so right when the cyber was hitting at its worst as far as the uptick of claims. And the question is, do you, the bank, have multi-factor authentication? If you haven't heard that term, or MFA, expect to, for all privileged users. And their response was, we do, but for some privileged users and not all. And just to give you a sense of what the response to that question was, the expiring policy was a $5 million cyber liability policy at $18,000. Based on that answer, the fact that it wasn't for all privileged users, it was a $1 million cyber liability policy at $75,000 in premium. That was the impact, because they see that the weakness in the MFA is causing these ransomware claims. You see the average claim for ABA is $54,000, and you're going to see a lot more data coming up. But that was the average claim for ransomware. Business interruptions is up, business email compromise is up, but the ransomware is what's really driving those. And if you think about this next slide, where the average ransomware demand was $175,000, you say, oh, that was different. Well, the $54,000 was the average claim that was paid. So maybe those that have insurance have less. But when you think of the actual demand, it's up to $175,000. And if you think about what you're paying for cyber, I think it's important to understand how different a ransomware claim is from every other type of claim. If you think about a D&O claim or an employment practices claim, those claims can take years, literally years, to resolve themselves. So during those years, what's going to happen? The underwriter is going to raise rates. They'll put up some reserves. They may earn interest on their premium. It happens very slowly. If there's a ransomware claim on a Tuesday, the expectation is that carrier is going to pay that on Thursday, right? So this kind of loss scenario, which was a bit unexpected, has presented a jolt. These paid claims, if you're paying, for example, $18,000 for $5 million and you have $175,000 ransomware, how many of those policies have to get written for the insurance industry to remain solvent? And $175,000 is just the average. CNA was reported to have paid $40 million in a ransomware claim for their data. So think about that claim and how many of those policies you have to write to cover a $40 million ransomware claim. So it's a very serious matter. And you can see here, the interesting thing enough, 54% said they succeeded in encrypting the data, and 65% said it was restored. So it's a good number, but there's no guarantee. And the total cost, right? So you saw before, the average ABA claim was $54,000. The average ransomware claim is $175,000 in total, and the average total loss, when you cover everything, loss of revenue, investigative costs, $1.85 million. So those are the impact potentially of a ransomware claim. And while the banking sector was not hit early on, we have seen a few more banks of lately get impacted by a ransomware attack. This next slide I love because it gives you a real life example, and it highlights in this example every aspect or most aspects of a cyber liability policy. So first thing we had was the discovery, and there was the access to the payment of $1.5 million. The first thing the bank did was they called the incident response hotline. That's covered as part of your policy. Access to that hotline. By the way, the hotline is almost always a law firm. You say, oh, I didn't get sued. But it's important to know that you want that first call after any type of breach, whether it be a ransomware or not, to go to a law firm to make sure that all subsequent communication relating to that breach or that ransomware is protected by attorney-client privilege. So all of the hotlines that are on your cyber liability policy will go to a law firm, and that's covered by that policy. The next thing was the forensics. That's a big part, a big part of the coverage of a cyber liability is what I call breach remediation costs, forensics, notification costs, credit monitoring, all those expenses associated with remediating the breach. And so that had to incur, that was part of your cyber liability policy. Then the negotiations and the payment. Your cyber liability policy will pay the ransom or the hiring of Russell Crowe, if you ever saw Proof of Life, to track the ransomware attack. Maybe a dated reference, but I think many of you may know that reference. In this case, $985,000 ransom, which was covered. System restoration, again, the restoring of your lost data can be covered by your cyber liability policy. The public relations expense, the PR firm to kind of support the bank during that critical time. The notification cost, still the most common use of a cyber liability policy is the cost to notify your customers. Every state has their own laws, and of course the credit monitoring is critical. The other area here I'd point out was one of the banks I had was the call center was a big part of that as well. And I'll share with you, that bank was a $2 billion bank. Their employee fell victim to a phishing attack. They clicked on a link they shouldn't have. As many as 35,000 of the bank's customers were potentially impacted. And all of these things were impacted. It wasn't a ransomware, but it did include the notifications, the credit monitoring, the public relations, the hotline, the forensics, all of those things. But the largest cost was the cost of the call center. Interestingly enough, was the building of the call center to support those calls. And finally, the liability of this particular bank did receive a class action complaint. And your cyber liability policy will cover the legal fees, the settlements and the judgments associated with that class action, that lawsuit. I will share with you that that's actually pretty rare, the liability aspect of it. This one was a good example, but it's important to know that the cyber liability cover, when built right, does cover all the aspects of this. I thought that was a great example to provide. This was just an IT professional's response. Recent ransomware attack. I have a copy of this. I thought the most interesting thing about this story that he told was that you thought you had backups, but if they're getting into the backups, they don't do it right away. That the most unaffected backup was over a week out of date. So that's really where the ransomware are successful, that if your backups are impacted as well, then they're not going to do you any good. So, so as much as possible that the backups are off-site, that are not connected to the network, the better you'll be suited in the case of a ransomware. You want to have, I always joke, it's good to have a local Commodore 64 on the side. Obviously, you don't want to be that outdated, but try to make sure that they're separate from your regular network. Otherwise, unaffected backups are not going to do you any good, or affected backups. So I thought that was pretty interesting. They did sign up for that monitoring program. Here you get some more ABA data. You see ransomware attacks in 2020 was the largest losses. And then wire fraud is still a big area. I will tell you right now, I have had probably 7 banks in the past 15 months that have had some form of funds transfer fraud. And it's a good thing to think about. People say, oh, I've got a bond, a banker's fidelity bond, I've got a cyber. They seem to have some similar coverages. I want to take this point to say a great way of saying, which policy responds to which, and there could be some overlap, but if you're worried about the loss or theft of tangible property, cash, securities, cash equivalents, it's going to be your fidelity bond that will almost always respond. If you're worried about theft or loss of non-tangible property, social security numbers, credit card numbers, personally identifiable information, it will be the cyber. Now, in addition to that, don't forget, your cyber covers you again for that breach remediation expense. So all the expenses a bank incurs, regardless if it was a loss of money or a loss of personally identifiable information, that'll be addressed by the cyber as well. But in the case of these wire fraud, the funds transfer fraud, very often involving what they call social engineering, also called impersonation fraud. We've seen a lot of these where banks are sending money to it's either to a person they think is a customer. Sometimes they think it's the CEO. Could even think it's a vendor. And somehow I've seen situations where there are email exchanges, and then the fraudulent party takes a recent email, replies to all, and says, "Oh, you know what? I talked to my lawyer. They want to send the money here instead. Here's the wiring." It looks like it was just a reply to all to that same email, hundreds and hundreds of thousands of dollars. That would be addressed by that social engineering coverage grant on your bond policy. So just be on the lookout for that. It's kind of in a similar model to a lot of those claims, not necessarily cyber liability, but one that's equally important, I would think, you should be aware of. So look for social engineering coverage on your bond policy as well. And then here's the breakdown of the premium, the payments. You see ransomware is the biggest portion of those payments. Breach response is a big portion, but I would argue that breach response is probably a majority of the actual count of the payments. But the ransomware is, so I would say the frequency is breach response expenses. That's a notification cost of forensics, the credit monitoring, but severity is ransomware. That's where the loss is coming. And then the next slide's a bit alarming. I think many of you probably have seen this. This is my own financial institution client data. What are the rate increases for cyber over the past 8 quarters? And you see for the fourth quarter, the average was almost more than a doubling. Now, some of these banks had claims, which did have an impact, but that's just the average. We've seen as much as a tripling of cyber premiums. And many we've seen at a 40 or 30 or 40 or 50% increase. But you should be expecting, and we found my clients are a lot appreciative of setting this expectation earlier versus a week or two before the renewal. So be warned, your cyber rates are going up. The good news is the number of cyber payments, actual ransomware payments, has gone down slightly the third and fourth quarter. And the other good news is, since this is felt immediately, I'm personally hopeful that it doesn't have a lingering impact. So this doubling of premium is what hopefully the cyber liability market is doing to remediate this. And then once it gets to a place where they're able to comfortably support the payment of these claims, it will, or hopefully will, level off a bit. But right now, this is the biggest pain point my banking clients are experiencing. Impacts carriers are dropping out. We're not offering, they're offering lower limits. We have some carriers that are saying, we'll offer you cyber, but we're not going to offer ransomware coverage, which, by the way, would go under the category of social engineering. The carriers are offering sublimits. So just be on the lookout for that coverage grant. Social engineering, ransomware or cyber extortion are the 2 areas you want to look out for. And the carriers have to do what they have to do to make this productively. So I'll take a deep breath. That's it. I have a sip of my green tea here. That kind of covers cyber. I think I don't know how I'm doing time-wise. The 320s, we're doing pretty good. I want to jump into D&O now. As Keith had said, I want to expand the coverage beyond cyber, but so I first want to give everybody, I always think it's valuable whenever I speak at a conference, or I'm always speaking to the board of directors of banks, what is in a D&O policy, and your policy, and most policies include coverage A, B, and C, and I always like to make sure we leave with a basic understanding. Coverage A is there to protect the individual directors and officers of a bank where the bank cannot or will not indemnify. So when is that going to happen? When is the situation where coverage A would pay out? Where there are two most common situations where the bank cannot or will not indemnify their directors and officers. One is insolvency, obviously extremely unlikely, but if a bank goes insolvent, it's not uncommon for a director and officer to get sued related to that, whatever caused the insolvency. The bank will say, I know I'm supposed to cover your legal fees. I know I'm supposed to cover the settlement and the judgment. We simply don't have the money. And therefore, we can't indemnify you. It is insured to cover coverage A. And that's one example. Another example is a derivative action. A derivative action is a lawsuit from the shareholders of a bank, but instead of being on behalf of themselves, the shareholders, they do it on behalf of the bank. A common example is they feel a director and officer is making money that he or she is not entitled to, ill-gotten gains. It could have to do with just compensation. It could have to do with, stock options or whatever. But if the shareholder goes, I know I didn't lose any money, but I feel you, Mr. and Mrs. Director, earned ill-gotten gains, and I'm suing you on behalf of the bank to return those ill-gotten gains back to the bank's coffers. That's an example of a derivative action. The bank cannot indemnify them. That would be circular in nature. If it's money is being returned to the bank, you can't give it. You can't give that back. But it is insurable. It's covered under coverage A. So what you think about with coverage A is, if it weren't for the insurance, the director or officer would have to pay out of pocket. That's what we call personal asset protection. That's coverage A. Coverage G is coverage B is there where individuals are still named, but the bank does indemnify. And I will share with you that's far, far more common. Individuals get sued, they have indemnification provisions which dictate the bank will indemnify them for any lawsuits relating to the work that he or she did on behalf of the bank, and then the insurance policy will reimburse the bank for that payment. That's what we call that balance sheet protection. And then coverage C is where the bank itself is named. You see the bank as a deep pocket and name the bank. So a great way of looking at this is what A and B have in common but not C is A and B individuals are named, and in coverage C, the bank is named. But what B and C have in common but not A is A protects the personal assets of the directors and officers, and B and C protect the corporate balance sheet of the bank. And what some banks are doing, and I will share with you, we see on our data, usually it's banks greater than 2 billion in assets, but some banks are doing it or less, is they're buying a separate and distinct side A liability over and above their A, B, and C. So a bank may have $10 million of D&O protection, of which that covers A, B, and C. It covers the individuals and the entity, and they may buy an additional $5 million, just as an example, of dedicated side A. So in that case, you would say the directors and officers have $15 million of protection, of which the first 10 is shared with the bank, and that last 5 is dedicated for themselves. It's also a way of saving some money. That side A coverage tends to be less expensive. And with the rates going up, particularly for the publicly listed banks, this is a way of getting coverage for the directors and officers. It is still limited because it's only there for cases where the bank cannot or will not indemnify, but it is a way of increasing limits. So that's there for you. A question I always get is limits benchmarking. So I want to share some data for you. And again, I'll have a copy of this. The first is the ABA data. So all you got to do is find out where you are, asset size. You see what the most, and this is hundreds of banks that are part of the American Bankers Association. And you have all different coverages, D&O, Bankers Professional, and you get a sense of what are your peer benchmarking data. The next one is similar, but it's travelers. So also a big writer bank space. You get, again, you just find your asset size and what they're buying from a limits perspective. The next one is kind of a subset of my clients, so you have a little more detailed information. You got the state, the private, public, 1 year versus 3 year, the carrier, the limits, the retentions, which you've not seen before, so that's pretty good. And then the cyber carrier and the excess limits. So a lot of great detail of what your peers are buying from a limits perspective, a little more granular in nature. This is another source. By the way, when we look at, the reason I want to bring this up is when we look at limits benchmarking, I want to show you a variety of data sources, and then you can make your conclusion based on the totality of the source, not just one. So when I show all this data to a bank, and I do this with Saltmarsh, because this is a lot of information we're sharing that you can utilize, but we want to have all the information available so you can make a logical decision. That's what the appropriate limits are. Advising is an insurance-wide data warehouse. This is banks in particular between 0 and $1 billion. And this just shows you the percentage of respondents that bought. So you see here, for all banks between 0 and $1 billion, the majority buy that $2 to $5 million in D&O liability, or 5 to 10. That's that biggest category. Next slide is utilizing Stanford security. This is more, how have these cases actually settled? So everything before that was kind of peer benchmarking. This is actually showing if you are a public financial institution and your market cap is between 0 and 250 or between 250 and $1 billion, how did those cases settle? And you get a sense of how they settled. Maybe for a smaller bank or FI, it's more financial institution, 83% settled below 10 million, not inclusive of defensive costs. And for the larger banks, it was below 25 million. So for public banks, this is good information based on your market cap. Not necessarily what your peers bought, but how did those banks settle? Another category, this is more of a survey we did. And the interesting thing here, the green line represents dedicated side A. So I point this out. This data is a little older, but you see, once you get above 2 billion in assets, a lot more banks are buying that dedicated side A. So that gives you a lot of fantastic data on limits benchmarking. You can take this now to your board and really have a logical sense of what the appropriate limits are. And again, my information is at the back of the presentation. If you want a dedicated presentation for your bank, happy to do that. I do want to talk about a process. And this just goes through a timeline to get the best renewal possible. I only want to focus on one part, and that is this particular bank was a September 1. What I talk about is 6 weeks earlier. What we do for every one of our banking clients, it really does generate the best results, is we host a D&O underwriter meeting, more likely a virtual call, with your incumbent underwriter, as well as usually it's between 10 and 15 other underwriters in the bank D&O space. We ask them for their questions in advance. We get that for you. For you public banks, it's similar to an investor presentation. I would joke the only difference is for an investor presentation, they like exciting and sexy and stuff like that. D&O underwriters like vanilla. They really like vanilla, plain, repeatable, small, slow, steady growth. But I know many of the banks I work with have that kind of approach. We look for you to give an overview of the bank's operations. If you're lucky enough to be on a 3-year policy, we'll have you, discuss the past 3 years. If you're on a 1-year policy, we'll have you discuss the past 1 year. And then we open up for questions. Again, many of the questions you would have seen in advance, never a gotcha moment. And I want to talk about the benefits of doing this. One benefit is we're including your current carriers. So if you're with, say, Travelers, your Travelers underwriter is going to hear and see the interest in the questions from Chubb and Zurich and CNA and ABA. So while I have no idea what your premium is going to be, I don't know what it's going to cost, I will tell you this leverages the competitive influence. This forces Travelers to know they're going to have to, quote unquote, sharpen their pencil. And it doesn't mean, by the way, we're recommending you move from Travelers. It just means that they know there's competition without you having to beat them over the head with that. Another benefit is if you think about what they're doing if not for this call, it's basically information that's on your call reports and on the insurance application. And for any of you who've had to complete an insurance application, there's a lot of questions which are very black and white. And you just wish you could add a little more context to the question, but you can't. And so those black and white questions, the underwriter, it's their job, to be honest, to assume the worst. But once you've had the opportunity to expand on any questions, to really give a story behind some of those, kind of question areas, it will allow them to assume the best. So assume the worst, they're giving you the benefit of the doubt. So that's another benefit. Another benefit, how do I want to put this? Let's say you work on a high rise and it's a windy day. There are mathematical actuarial studies that can predict, let's say there's a 4% chance that individual is going to get hurt. And underwriters underwriting that individual can use those actuarial studies to price out how much the insurance should be to protect that individual. I've been doing this. I worked at AIG for 7 years. I worked as a broker for over 20. I've been in the bank. I was at a bank for 7 years myself. I've been doing banking, but more importantly, I was in the bank D&O space for over 25 years now. I can promise you that there's no actuarial studies that can predict the next time a director or officer is going to get sued. It just doesn't exist. So what D&O underwriters need to do to replace that arrow in their quiver is what I call perceived quality of management. And by listening to you, understanding you tell your story, understanding that you're conservative in nature, that you understand the market you're in and the segment you're doing, that you're not going to take undue risks, that gives them a great understanding of the quality of management. And so that's another benefit. Another benefit, if you think about, is we pretty much say, speak now or forever hold your peace to the underwriters. You have the executive team on. And so if you think about it, if not for the call, they would email the broker a question, the broker would email you, you respond to an email. And if you think about it from a risk management perspective, it's better to answer a question verbally versus an email. So we do this. We strongly recommend you do this process at least once every 3 years. Have all the underwriters tell you a story. It really allows you to separate yourself from the other banks the underwriters are looking at, and it really does get the better results. So everything else there is pretty self-explanatory, but I do want to highlight that D&O underwriter call. Here's a list of the carriers. You can see Travelers, ABA, Chubb, Zurich, CNA. Those are the top 5. We work with all these. Gives you a sense of who the markets are. And I think we're just about done, which is great for you. I do want to highlight kind of a top 12 list of coverage improvements that you want to make sure you have. And again, when we talk about language, I think the important thing is, and we spend a lot of time doing this, the policy is only as good as the language in your policy, is we try to broaden the definition of claim, broaden the definition of loss, broaden the definition of insured. Those are 3 big ones. The broader you can make claim, loss, or insured, the more likely something that happens will be captured under a claim for a certain individual as a loss. And then with regards to exclusions, we restrict them as much as possible. We try to add carve-backs to that exclusion. Whenever you can carve something back to the exclusion, it restricts it. So simply by looking at the gold standard, which some of these are, to broaden the definition of claim, loss, and insured, and restrict exclusions, it allows us to have the broadest policy. Because again, I was at AIG for 7 years, and people always will say to you, well, this language isn't here, and they're going to deny a claim, and that's the scary thing of denial of claim. And I will share with you that it actually is pretty rare for a carrier to deny claims frequently. What ends up happening is they end up getting a reputation, it ends up getting out. And so what's more likely to happen is a conversation will go something like this. You see here, Mr. and Mrs. CEO, CFO, we could deny this claim if we wanted to, but we want to work with you. So how about we agree on an allocation? We'll pay 50 cents on the dollar and you pay 50 cents on the dollar. And then that doesn't get out. It seems like it's a fair judgment, And so by shoring up all these policy languages, we want that conversation to go from 50-50 to 90-10, or ideally 100 cents on the dollar. So that's how important it is to look at the language of a policy. So I think that's it. Here's about us. Here's my contact information. You'll have this. Here, we have a little fun here. Here's where we fit in the different areas. We kind of, we like that kind of quadrant, if you would. So I think I'll kind of leave you with that, and I'll see if there's any questions that came up. And I hope you enjoyed it. And I hope with your partnership with Saltmarsh, you found some value in what I had to share with you.
Thanks, Dennis. I appreciate your time. And again, I shared with you at the beginning of this, no one ever is disappointed to get some extra time. So we'll make sure we get everybody off here in a little bit. But a couple of quick questions for you, if you don't mind me, I guess kind of me asking. So from your perspective, from an insurance, actually having clients with an insurance issue, if somebody has a cyber event, what does that look like on your side? How do you get notified? How much are you involved? What does the insurance companies or the broker's perspective in there? Is it just the call gets made to the attorney handles it from there, it goes to the insurance company, the payouts there, or do you find that you get looped into these kinds of conversations pretty quickly? And what do you have any suggestions in that process for somebody who might go through one?
That's a fantastic question, by the way. Thank you so much. Actually, I would break up into two categories because you mentioned cyber, and cyber is kind of an animal of its own. When there's a cyber claim, and by the way, we do a lot of, and I recommend on cyber, you do a lot of tabletop exercises, and I bet you Saltmarsh could help with that, to walk through when should the insurance carrier be notified, and when should the broker be notified. But when you get to the stage of, this is a lot more serious than one person not having access. The first call is probably going to go to the 800 number on your cyber liability policy because you want to get them involved as quickly as possible, and you want to get, again, that protection of attorney-client privilege. The second call should go to us because that in of itself does not make it meet the definition of reporting. We still have to report it to the carrier, but you will let us know a summary of it, and we'll report that to the carrier. But a lot of that work is going to be with the cyber liability carrier and your third-party providers to do the forensics and the call monitoring. And, we're involved in that, but, very often they don't want us to be involved because there could be some disclosure there. They want to keep it as kind of inside the belt as possible. But we should know because we need to report that. On pretty much any other type of claim, the D&O, the EPLI, your broker would be the one you call first. It's a very often conversation. You should do it very early on. I've seen more claims denied by breach of the notice provision. That notice provision is critical. I'll just give you an example. The worst language it could be is, you have to notify us within 30 days, the insured has to notify us within 30 days of discovery or we're not going to cover it. Insured is a wide open. Who's an insured? It could be like a loan officer who may not even know about the insurance. And you have a 30-day window to report that, or you'll be in breach of your notice provision. The best language could be, we need you to notify us, the carrier, as soon as practical, once the risk manager or the CFO or the general counsel find out. So you limit it to where that clock starts ticking. And then you have as soon as practical language with something like 60 or 90 days after the policy expires. You have a very large window. So you want to notify us, though. We'll have a conversation as long as we're in that window. We want to have a realistic conversation. Is this something that we think may rise to a claim? Have you incurred legal fees already? Should we report this? I will tell you, most times I would imagine your broker errs on the side of conservatism, and we're going to report that at least as a notice of circumstance. And then we are very much involved at every stage of that. It is not uncommon for an insurance carrier to leverage the language in a policy to respond, but they may not realize their endorsements or riders, as you had said, which are used to address some of those things. And it's our job to be your advocate throughout the whole process. And I would argue for the first several months, your broker is very involved in negotiations. And then at one point, when we get to finally, where we've done everything we can, where we've leveraged the policy, and hopefully we've gotten some good results, then when it goes to lawyers, then maybe we step out and your outside counsel would be involved with the carrier's counsel. But there's a lot of work your broker will do on your behalf up until that happens to be your advocate during that claims process. That work?
Then, yeah, I think that's a pretty reasonable response there.
Yeah.
Then, and you may not have any that come to mind, but it seems like every time you look at insurance policies, every time you talk about contracts and agreements, folks have kind of their pet peeve of what particular language or what particular writer or what particular clause sometimes gets thrown in. Is there anything that comes to mind that you see that you're concerned about, or that you want, that you would suggest somebody say, hey, this is one that just really to me is a non-starter? And maybe you already went there. You said the 30 days.
No, that's a great question again. There are three things I've seen where I've seen the most denied claims. So that'd probably be the easiest way. Where are you seeing things? Where are you seeing the policy language? And by the way, these are things that are different from policy to policy. So where are the things you can negotiate? The one is that notice provision. So that's an important one. You do not want to, you want to look up your notice provision. You want to search for the words as soon as practical. Those are good language to see. And you do not want to see any language that says you have a window of time, 30 days, 60 days from the day you discover the claim. And again, you want to have a limited group of people who are responsible to provide notice. If it says the insured can provide notice, that's bad, because that's a wide group of people, and that clock starts ticking when any insured may know about a claim that may not even realize insurance exists. So that's number one. Number two is what we call the fraud exclusion. It's also called the conduct exclusion. It's fraud or personal profit. And I will say that 90% of the claims I see usually have allegations of fraud or personal profit. And there are several ways that could be written. One is the carrier saying, we're not going to cover a claim for fraud or personal profit as determined in fact. And that's another word you should search for. That's really bad. What does in fact mean? Well, we don't know. That's the problem. It could mean admission, written evidence, arbitration, mediation. It's what we call a very wide burden of proof. And if you have that language, it means the carrier can trigger that fraud exclusion or the personal profit exclusion very easily. The best language is, we're not going to cover fraud. We're not going to cover a claim for fraud or personal profit as found by a final non-appealable adjudication in the underlying action. And by the way, if you see the words final adjudication, that's pretty good. So let's leave it at that. We're not going to cover a claim for fraud or personal profit as found by a final adjudication. That is a very restrictive burden of proof. And by the way, if you can see non-appealable in underlying action, that's even better. But it really, really restricts when they can trigger that exclusion. And what's going to happen is, if you see that a fraud is going to be determined by a final adjudication, you're simply going to settle before that occurs. And as long as you settle the claim before that adjudication happens, they can't trigger that exclusion. The claim is covered. The other one I've seen is some D&O policies, particularly directors and officers liability policies, will have a form of a cyber exclusion. And I've seen some cyber banking or electronic banking exclusions. So go through the exclusions in your D&O policy. Make sure that there's not a cyber or electronic banking or funds transfer exclusion on your cyber policy. It's intended to be addressed by a cyber, but a lot of banks have their D&O policy with one carrier and their cyber liability policy with another, and that could create a gap where the language in your policy is supposed to push that claim to a cyber, but the cyber is with a different carrier who has no intent of covering that. So really be on the lookout for any form of internet banking, electronic banking, cyber banking exclusion on your D&O policy.
Excellent. I think that's it for me. Nancy, you got any other questions that have come in?
It doesn't look like any more questions have come in, but thank you, Dennis, so much for taking your time today and presenting on this topic for us. And thank you, Jason. As we mentioned before, today's webinar was recorded, and everyone will receive a link to that recording and the slide deck tomorrow in their email. Be sure to check your spam and junk folders in case it gets stuck in there due to security filters. And remember, take our survey. We'd love to know your feedback about today's session, and we hope you guys can share other topics that you'd like to see. With that, we're going to let you guys go 15 minutes early, and have a great day. Bye.
Bye.